Hi, today let's try to figure out if you are a greedy investor, what type of investment philosophy do you follow in your investment routine, and why is it important to know about your investment philosophy? I think investment philosophy is a very important uh, technique. You should always know your own psychology and try to avoid the traps that your own temperament can lead you into. Okay, so let's begin. We're trying to figure out our investment styles, and this video is dedicated to people who are new to the stock market, right? And why do I think that there are a lot of new people in the stock market? Because in the past 2 years, Zerodha has um, put out numbers saying that there has been fourfold increase in the number of new retail investors. So there are a lot of new people who have started joining the investments and stock market, individual stock picking in 2020 and 2021. So the numbers that they have reported is from existing 20 lakh subscribers in 2020. Now the number of subscribers is at 80 lakhs. So 60 lakh people have joined on Zerodha alone, and I'm pretty sure the numbers must be similar for Upstocks, Grow, and every other uh, mutual fund or stock investment app, right? There are a lot of them for banks and stuff like that. So there is a lot of increase of retail investors to the scene, and I think people should invest in knowing their psychology and their investment style, so that they can better expect their returns and know when to avoid certain pitfalls for your investment style. So there is a famous saying about experience in the stock market. Like every time a market crash happens, money goes from less experienced investors to more experienced investors, and experience goes from lower to higher. So there is always an exchange of money and experience. People who don't get the money get the experience, and people who have the experience get the money. So I know a lot of you are new and will not agree to this age-old wisdom, but let me give you that this is the truth, and I have learned the hard way, and so many of us retail investors will learn and continue to learn the hard way. Investment styles help you know what kind of risk appetite you have, and why is risk appetite important. If you go to any investment advisor, he will tell you, he will ask you a few questions trying to gauge what kind of risk appetite you have. Do you even have a risk appetite to stay in the equity market? Are you okay with knowing for a fact that you might wake up tomorrow and 40% of the market is down and your entire portfolio has lost 80% of its value? Can you sleep that night? Can you handle that much pressure? Those kind of things will be asked by your wealth advisor or your investment manager to see what kind of investments you should prefer. Now, because everybody has joined the stock market, or a lot of people have suddenly joined the stock market without understanding their risk appetite, I think your investment should speak more about your risk appetite than a questionnaire, right? If you were to put me on the spot 10 years down the line or 8 years before, then I would have not been able to tell you what type of investor I am, because I only studied stocks and I did not invest, right? The moment I had to put my money down, and now looking at my portfolio, which is 8 to 10 years old, I can see what type of investor I am and what makes me comfortable, what makes me sleep at night. So knowing my risk appetite, I know for sure what I will invest in the future, what kind of investments I will like and what kind of investments I will not like. So these investment styles will help you answer these sort of questions for your entire portfolio management, and not just for individual stock picking. So there are 4 investment styles which are widely known, and there is a lot of research and a lot many books have been written on these investment styles. They are value, growth, momentum, and thematic. So we'll go over each of these investment styles in the next slides. Okay. So what is the value style? Value style is the old style, is the Buffett style, that I want to keep in my mind. That is my mnemonic for it. And if you are a value style investor, you're always focused on future cash flows. FCF is your go-to term. You always try to see if you can find discounted cash flows. You're trying to find value in a stock where the market has missed that value. You care about margin of safety. You are a safe investor. You say that, okay, I've calculated this value for a stock or this price for a stock, but I don't necessarily agree to it. You think that there is some error in every calculation, and you want a margin of safety. It can be 20%, 30%, or if you're ultra conservative, it can be around 50% as well. So I've seen people who only invest when their calculations lead to a certain price for a stock, and if that stock is trading at a 50% discount to that calculation. So there are so much conservative investors as well. So if you care about future cash flows, you care about a healthy margin of safety, you are a value style investor. Another thing is you think that the intrinsic value for a stock predicted by the market is wrong. So what you are trying to say is that the stock market at this current price has not computed the value for this stock correctly. There is a lot of cash flows which the market has discounted for no good reason, right? You see that there is the earnings are high, the PE is low, the sectoral PE is high, or it should be high, right? You see that the cash flows will improve and the price should definitely improve in the future. And when you have this type of thinking, you are thinking in value style of investing. Yes, this style of investing is objective. The ratios are in front of you. There is a little margin of error. You think that whatever has happened in the past will happen in the future as well, with certain amount of flexibility. And you want to invest in stocks which have provided strong results over multiple cycles. So multiple economic cycles have happened. There has been a capex cycle or two capex cycles, and these stocks have proven their worth, and you want to invest in these stocks. So this type of thinking is again value style thinking. And if your portfolio has returned 70 to 80% absolute returns in 2020 or 2021, you should know that you are a value style investor. And this is just me taking a guess, okay? Because even after going through all the definitions, you might think, okay, Piyush, I think I have multiple traits of various styles, right? But every one of us has multiple traits. But if your entire portfolio, and by portfolio I mean individual stock picking, plus mutual fund, has given you around 70 to 80% absolute returns combining 2020 and 2021, you should know that you are a value style investor, because of the market bull run, 70 to 80% returns were less in the past 2 years. And if you're happy with these many returns, it's mostly probable that you are a value style investor, according to me. Now moving on to growth. So how do you identify if you're a growth style investor? You're excited for IPOs, you're excited for futuristic companies, and I mean, IPOs are great. I mean, I'm very happy that Indian IPOs have really found a space on the Indian stock market, and they don't have to go to New York Stock Exchange or NASDAQ to list Indian companies and value Indian talent. That is all great. But for IPOs, how can a new company be the most valuable company on the street, right? Imagine that there is a lot of existing companies in the Indian stock market, right? There is 5,000 companies. There is a new company coming in which has created so much value so that it's the best, most valuable stock you think for this day. I think that is a very difficult conversation and a very difficult judgment to have, saying that a new company is the most valuable company. And if you get excited for these new companies, I think you might have a growth style of mindset. Old school valuations do not value these companies correctly, because they are not profitable, their ratios are all over the place, and you don't know how to value them. But you see that a lot of VCs, a lot of foreign investors, domestic investors are valuing them, investing in them in the future. So you don't know what is happening, and old school valuations do not really matter in this type of stocks. In here, for this style of investment, what you are saying is that the intrinsic growth computed in the market is wrong. You are saying that for this company, whatever is the value that you are assessing is wrong, because the growth associated with this company is wrong. So earlier in the previous thing, what you are doing was, you are thinking that there is value in the company which is visible in the ratios, but the market has not priced it in. So it was a very visible error that the market is making. Here, what is not visible is more important. You're thinking that companies like Nykaa and Zomato are very high growth companies. They will scale, and their user base will increase, and then their per user spend will increase, and nobody can know about this growth beforehand. But you have a hunch, or if you but you have either a hunch or you have some knowledge related to this, and that is why you are pricing these companies way higher than anybody else. So in this style of investing, growth is what is wrongly computed by the market, but you are pricing in for the growth, and that is why you will have a higher return for these companies. The analysis again here is not objective. The ratios will not be there. There will be no cash flow, not justifiable cash flow ever. The PE ratio will always be a whack for these companies. So anytime you see a PE of like 90, 100 or even more than that, you should know that these are like growth style companies, and people are valuing them for the growth that they are going to bring in, not because they think that this company will keep on growing at 100 times year on year, right? So that's my thing, that the objective analysis will always look bad for this style of companies, but subjectively they will have a really sound statement. And my last metric is, if you have gotten 80 to 100% absolute returns in 2020 and 21, so if you just see what you have invested in 20 and 21, and if those returns have doubled by the beginning of 22, you have invested in the growth style. The growth mindset has earned more, and depending on what kind of cycle we are in, the growth and value keep on switching positions in what will get more returns. But because we are at the beginning of a bull market, the absolute returns for growth style would be 82 to 100% for 20 and 21 combined. So this is another metric for you to understand your own style. The next style is momentum. Momentum is a very risky style, and the way to identify is, if you do day trading, or if you're very excited about Bitcoin, that is what I think is more momentum style. In this style, you don't care about the value or whatever stock it is, or what is the underlying value of that stock brings. You are investing more on signals saying that there is a doji pattern formed, or something of that sort, right? There is patterns forming in trading charts, and Bitcoin has value because X foreigners have started taking this for Y reasons, and so many countries have started taking it. This is a very weak argument in general, right? What kind of value Bitcoin has, or what kind of patterns lead to what kind of investments in stocks are very dodgy things, to be honest. So if you invest in this way, thinking about patterns and thinking about not thinking about intrinsic value of things, then you follow momentum style of investing. Just a caveat here, Zerodha CEO recently made a comment saying that 1% of active day traders on Zerodha's platform are profitable for the past 1 year. So in momentum style, you will always find people who claim that one of their investments has made them rich by 2000, 3000%, right? But how many have made them poor? Nobody is going to be transparent with you in how many of them have made them poor. So the truth is, 1% of active day traders, if you do active day trading, only 1% of you have been profitable, and by how much profitable, I don't know. These kind of numbers are not very easily available, and only my day trading friends can let me know how much profits that they can get. Again, this style of investing is very gambling. It's more towards gambling, and that is why people are more influenced towards leveraging, and by leveraging I mean taking a loan. So these kind of investors, or traders I should say, have a tendency to take a huge amount of loans and invest that loan amount into their trading, and then either get humongous returns or get humongous losses, and then that's their career, right? So You either make or break in a few trades. That if you have this kind of trades, then you are more towards momentum style. And returns are unpredictable. I have not found how much have those 1% day traders returned on average, and if trading in itself is a good investment in time and effort for investors is something that I have not found any research. And there are books written about traders, and I am pretty sure that they must have enough knowledge and deep knowledge about how much average returns should a trader expect in the Indian stock market, but I don't have that knowledge. And the last one is thematic. So for thematic style, you focus more on the macroeconomics. So you know about what is happening in India or what is happening globally. You know what kind of interest rates, repo rates are happening. You know what is happening in China's production. If China is going to force new things, force new laws, force new taxes, and that is why India is going to gain a strategic advantage. These kind of things you are aware of, and you know how to play them. So that is a more thematic style of investment. You have deep understanding of sectoral themes. So like now, if you are seeing steel has taken their portfolios to new highs, right? Nifty, the companies in Nifty which have steel like Tata Steel and others have taken huge growth in Nifty's index, and this has not happened for past many years, but because of current cycle, people who were invested in steel at the right time are now reaping 80 to 100% results in the past 2 years, I think. You understand special situations like mergers, you understand acquisitions and stuff like that, and then you invest in stocks. You invest in knowing that two companies which were thematically similar will get a combined output which is much more than both those individual companies, and that is how you make extreme returns in the thematic style. And in looking back at steel for 2020 and 21, which has been the most outperforming thematic investment I can think of, it has returned again 80 to 100%. So this is pretty much like the growth returns that we observed earlier, but this is more involved to macroeconomics. And if you understand the bigger picture and how your themes will play out, this can be pharma, this can be healthcare, this can be anything, right? So if you understand your themes really well, you can get similar numbers too if those growth stories played out like in the past 2 years. Alright, so for the key takeaways for this video would be no style is permanent and all are good. So you must be wondering like, hey, do you bashed momentum like anything and you are saying that all are good? So there is for traders there is this thing called algo trading, and I think Jack Simons is a name which comes to everyone's mind when they think of algo trading, and that guy has proved that he can get extremely good results from day trading. And that is why we have to acknowledge that if you know which algo to follow, or if you can follow your own steps, you can get good stop losses, you know what signals to follow, you can definitely earn money. But it is very, very, very difficult to do, and very few people have to do it, and it's very attractive for new investors to get into trading, but it's very difficult to achieve any good results. So that's why even momentum style is good, but you have to be very, very, very disciplined for it. My another takeaway is never leverage. Don't take a loan. Don't take a loan from any bank. Don't take from your relatives. Don't take from close friends. Don't take it from your parents even if you want to invest. Investments are subject to market risk, like we always say, and please do not take any loans if you're investing. You'd never know when you have to exit. You can predict anything in your life, but bad times will come at any given point. So please do not take loans. You will be wiped out completely. You will have to work 10 times harder just to repay back your loans. So please don't ever leverage. And expectations wise, what should you expect? So Warren Buffett is only one guy, right? And he's the guy to go for active stock investing. and that guy has returned 20% CAGR for 50 plus years. That is it, right? It's just 20% CAGR. Do you think that whatever you've returned in the past 2 years, 80 to 100% returns is what we are seeing, right? Or even more than that, if you had more concentrated portfolios, you're probably twice, thrice, or 4 times your investment you've made. Do you think that your 300%, 400% CAGR will continue forever? And if they do, then you will be known as the new Warren Buffett, who is only one investor who has so much fame and so much glory that everybody tries to emulate him. So what I'm trying to say is the law of averaging will catch up with you. Don't be greedy. There is only one Warren Buffett, there is only one Monish Pabrai who has taken 26% CAGR for the past 20 years, right? So if you are enjoying this bull market, enjoy it with a pinch of salt, saying that the future years will not have so much growth. The future years will definitely be flat or with single digit earnings, right? So that is my pinch of salt for you. And another one takeaway is analyze periodically. For new investors, they keep on analyzing day in, day out. You should analyze it as much as you want. There is no fees of analyzing your portfolio, but don't change your portfolio. An actively managed stock market portfolio, either you or managed through a mutual fund, will take 3 to 5 years to show its true value. Definitely after 3 to 5 years, if you think that it's only returned 10%, 12%, single digit return, throw it out, throw it entirely out. Take your tax hit and invest in a different mutual fund, or invest in a different bunch of stocks which can help you get more returns. But wait at least 3 years to see if your investment style is suiting you, or if all the market conditions have played out or not. So those are my key takeaways. Again, this is not investment advice. I'm not a wealth advisor. Please invest with consulting your wealth advisors. And thank you. And I'll do a more detailed video for investment styles. I'm reading a book by Aswad Damodaran, and there is much more detailed information in that. I'll do a much more detailed intro later. Thank you.